You've spent years chasing the Holy Grail. You've downloaded every indicator, you've memorized every candlestick pattern, and you know intellectually that the market is a probabilistic game. And yet, when the moment of truth arrives, when the setup is perfect, you hesitate, or you over-leverage, or you hold on to a loser out of sheer blinding ego. Why? The market is not a puzzle to be solved. It is a mirror. It reflects your deepest flaws, your lack of discipline, and your internal chaos directly back into your brokerage account. The painful truth is this. Your failure to profit has almost nothing to do with whether the S&P 500 goes up or down tomorrow. It has everything to do with whether you can remain a rational, clinical professional when the money is on the line. Trading is a serious business. And like any serious business, like surgery or engineering, it requires a complete system, not a collection of fragmented tips. I call this system the 3 M's. These 3 pillars, mind, method, and money, are the only things that actually control your destiny in this game. They are not suggestions. They are the architectural foundation of survival. You can have the best entry signal in the world, but if your mind is poisoned by fear, or your money management is reckless, that signal is worthless. The structure collapses entirely. For too long you have focused on method, the charts, the patterns, and ignored the 2 M's that truly matter. We are going to change that. We start immediately with the most overlooked yet most destructive force in your trading life, your own psychology. We start with mind. Stop searching for the Holy Grail indicator. Stop chasing signals, patterns, and gurus, believing that if you just find the perfect entry technique, you will somehow finally conquer the market. This is the great deception. The market is not a puzzle to be solved with mathematics. It is a profound mirror reflecting your own internal chaos. Look at the statistics. 95% of those who enter this arena leave broke, demoralized, and often blaming the market for their failure. Why? They blame the method. They blame the news. They never, ever look in the mirror. They fail because they have focused their entire energy on the chart, yet ignored the 2 critical pillars that hold the entire structure upright. The secret to sustained professional profitability is not a secret at all. It is a foundation built on 3 non-negotiable pillars, the 3 M's, mind, method, and money. If your mind is poisoned by fear, or your money management is reckless, that signal is worthless. The structure collapses entirely. For too long you have focused on method, the charts, the patterns, and ignored the 2 M's that truly matter. We are going to change that. I have spent decades studying the pathology of the loser, examining why brilliant, educated people repeatedly self-destruct the moment they put real capital at risk. The 3 M's are not just trading concepts. They are the fundamental weapons you use against the enemy within. This blueprint is the difference between a gambler chasing luck and a professional building equity. We start immediately with the most overlooked yet most destructive force in your trading life, your own psychology. We start with mind. The greatest discovery you will ever make in trading is that the market is not a distant external entity. It is a mirror. It reflects everything that is undisciplined, chaotic, and destructive within your own mind. That is why M1, the mind, is the absolute foundation. Fail here and the best methods, the best indicators, the best money management systems in the world will simply accelerate your failure. The battleground is internal. Every professional trader knows this, but the amateur ignores it, chasing signals when they should be chasing self-awareness. The enemy is not the Fed or the hedge funds or some shadowy manipulator. The enemy is the pathological duo that resides in every human brain, fear and greed. I call this the trader's disease. Greed whispers to you when your trade is up 5 points. Don't take the profit now, it's going to 10, it's going to 20, you deserve this. Greed is the force that makes you cancel your protective stop-loss, transforming a healthy winner into a devastating loser overnight because you couldn't bear to leave money on the table, Fear, conversely, is the sudden cold dread that strikes the moment the market moves against you by a single tick. Fear makes you panic sell your best positions right before the true trend begins, locking in a tiny loss and then watching from the sidelines as the market rewards the patient. To succeed, you must achieve clinical neutrality. You must approach the charts and your capital with the detachment of a surgeon. Think about it. Does a surgeon operate based on how much they hope the patient lives? No. They operate based on protocol, procedure, and cold, hard data. Their hands must be steady. Your trading must be just as steady. You must treat your capital like sterilized instruments. Your feelings have no place in the operating room of the market. Zero. But how do you achieve this clinical state? You cannot simply suppress emotion, you must analyze it. This leads us to the single most critical tool in your entire arsenal, a tool that is fundamentally psychological, not technical. The trading diary. Most people use a diary as a logbook, entry, exit, profit. That is worthless. A professional uses the diary for self-psychoanalysis. Alongside every single trade, you must record your emotional state. Why did I enter? Was I bored? Was I trying to impress someone? Was I feeling desperate after a prior loss? How did I feel when the trade went against me? Did I feel panic? Did I feel defiance? This emotional tracking is the only way to expose the subconscious triggers that routinely sabotage your method and your money management. The ultimate failure of M1 is the destructive revenge trade cycle. This is where the ego takes over. You take a legitimate loss, which is tuition, by the way, not failure, but your ego cannot accept being wrong. The market, in your mind, has insulted you. So what do? You abandon your protective stops, you double your position size, and you rush back into the fray, desperate to prove that you are smarter than the collective wisdom of the world's investors. This is self-immolation. The market is an indifferent machine. It doesn't know you, it doesn't hate you, and it certainly doesn't care about your need for validation. When you engage in a revenge trade, you're not trading the market. You're trading your own anger. And anger is a terrible capital allocation strategy. The result is inevitably a second, much larger, and far more painful loss, shattering your confidence and often wiping out weeks or months of diligent work. M1 mastery means accepting that losses are inevitable. They are simply the tuition you pay to stay in the game. It means exhibiting extreme patience. Patience to wait days or weeks for the perfect setup that meets all your clinical criteria. And patience to sit through the inevitable choppy waters without flinching. If you can master your mind, you have defeated the most dangerous opponent you will ever face. If you cannot control the fear of loss, you will never hold a true winner. If you cannot control the greed for more, you will never keep your profits. Remember this absolute truth. The market doesn't care about your rent, your car payment, or your desire for an early retirement. It is indifferent to your circumstances. Your first job is not to analyze a chart, but to psychoanalyze yourself. If you cannot control your mind, the best method in the world is useless. You are simply giving a loaded weapon to a child. If you cannot control your mind, the best method in the world is useless. You are simply giving a loaded weapon to a child. This brings us to our second essential M, the method. If M1, your mind, is the discipline that keeps your finger off the trigger, M2 is the instruction manual that tells you precisely when and how to aim. The method is the objective, emotion-free set of rules that replaces hope, greed, and fear with simple, cold logic. When traders fail, they usually blame the market, the news, or their broker. They never blame their system because they don't have a system. They have a feeling, they have a hunch, they have a prediction. A method is not a prediction. A method is a contingency plan. It must answer 3 questions before you even consider entering the market. Where do I enter? Where do I take profit? Where do I accept defeat? If you cannot write down your rules and follow them mechanically, you do not have a method. You have a gambling habit. Now, The most common flaw I see, the flaw that chops up more promising traders than any other single mistake, is the flaw of single time frames. Tell me, how often have you stared at a 15-minute chart, felt certain the market was going up, bought the stock only to watch it plummet 5 minutes later? You feel betrayed. You feel confused. You blame the volatility. But the volatility wasn't the problem. Your vision was the problem. You were looking at a single tree and believing you understood the entire forest. The market is fractal. It looks like chaos up close, but it organizes into structures when you step back. To trade successfully, you must align your analysis across time frames, or you will be chopped to pieces. This is why I developed the triple screen framework, the most critical component of your method. The triple screen forces you to step back, forcing patience and perspective. Screen 1 is the tide. This is the weekly chart. It tells you the primary, overwhelming direction of the market. You must identify the major trend, the tide, because you do not fight the ocean. If the weekly chart is trending up, you are only looking for opportunities to buy. If it is trending down, you are only looking to sell short. You are aligning with the dominant force. Screen 2 is the wave. This is the daily chart. If the tide is rising, screen 1 is up. The wave is the temporary correction, the pullback, the inevitable dip that frightens the amateur. We use the daily chart to identify when the market is pausing or retreating against the tide. This is the moment of opportunity, but it is not the moment of entry. Screen 3 is the entry. This is the tactical chart, the hourly or 30-minute time frame. This is where we pull the trigger, but only when we see the wave, that daily correction, turn back and align itself with the tide. You see the discipline this demands. You wait patiently while the tide flows up. You wait even more patiently while the wave pulls back, and you only execute when the wave reverses and starts flowing with the tide again. This framework forces you to buy weakness in an uptrend and sell strength in a downtrend. It is the core of professional trading. But a method is only valid if it has stood the test of fire. Before you risk a single dollar of real capital, you must subject your method to rigorous validation. You must backtest. You must paper trade. You must prove intellectually and mathematically that these rules provide a positive edge over hundreds of hypothetical trades. If you cannot do the work, if you refuse to validate your method, then you are simply trading on faith, and faith is the market's favorite victim. Amateurs hunt in the forest with a flashlight, seeing only the few feet in front of them, constantly surprised by what jumps out of the dark. Professionals use satellite imagery. The triple screen is your satellite imagery. It gives you the high-level perspective necessary to navigate the terrain. Only when your mind is controlled and your method is proven are you ready for the final, most mechanical Only when your mind is controlled and your method is proven are you ready for the final, most mechanical M. This is M3, money management. If mind is the internal discipline and method is the external map, then money management is the safety harness, the parachute, and the ironclad hull of the ship. Without it, you are guaranteed to sink. This is not merely a component of trading, it is the survival imperative. You see, the market does not care how smart you are, how beautiful your charts look, or how passionate you are about your stock. It only responds to capital flows. And your primary non-negotiable job as a professional is the preservation of capital. Amateurs focus on how much they can make. Professionals focus obsessively on how much they can lose. The reason for this focus lies in a brutal, often ignored reality, the mathematical asymmetry of loss. Listen to this closely. If you lose 10% of your account, you need an 11% gain to get back to even. Manageable. But if you lose 50% of your account, you do not need a 50% gain to recover. You need a 100% gain, twice the effort, twice the risk, just to get back to zero. This asymmetry is the trap that kills the reckless. It is why you must treat M3 as the most critical M of all. It is the wall that stands between you and financial ruin, ensuring that no single mistake, no sudden news event, no psychological lapse can ever be fatal. M3 requires two ironclad, non-negotiable rules. Rules that remove your emotional, greedy self from the decision-making process. The first is the 2% rule. In any single trade, your maximum acceptable risk, the difference between your entry price and your protective stop, must never exceed 2% of your total trading equity. Not 5%, not 10%, 2%. This rule is not just about risk. It is the ultimate dictator of position sizing. The market does not tell you how many shares you can buy. Your 2% risk tolerance does. If you have a $100,000 account, your maximum loss on any trade is $2,000. If your stop loss is set $2 away from your entry, you can buy 1,000 shares. If your stop must be $5 away, you can only buy 400 shares. This mechanical discipline forces you to trade small enough that a streak of bad luck cannot destroy your capital base, or crucially, destroy your confidence. The second ironclad rule is the 6% rule. This is your monthly drawdown cap. If your total equity loss for the month reaches 6%, you must stop trading immediately. You must close all positions, step away from the screen, and take a mandatory timeout. Why 6%? Because hitting that level signifies that something is fundamentally broken. Either your M1, mind, has succumbed to fear or greed, or your M2, method, is failing in the current market environment. The 6% rule prevents the lethal spiral of revenge trading, where the ego demands you make it back only to dig the hole deeper. It forces you to retreat, review your process, and wait for the fog to clear. Central to both of these rules is the stop loss. The stop loss is not a suggestion. It is a binding contract you make with yourself before you ever enter the trade. It is the price at which you admit you were wrong and you walk away with dignity. If you move that stop loss farther away from the market to give the trade just a little more room, you are tearing up the contract. You are allowing hope, the most dangerous four-letter word in trading, to override your discipline. A stop loss can only ever be moved in one direction, closer to the entry, to lock in profits or reduce risk. Never farther. If M1 is the mental discipline and M2 is the map, M3 is the safety harness and the parachute. Without it, you are guaranteed to hit the ground. If you cannot define your maximum risk before you enter the trade, you are signing your own financial death warrant. Master the 3 M's and you will move beyond the amateur's cycle of euphoria and despair. You will become a survivor. You will become a professional. And this brings us to the fatal flaw, the point where most traders, even those who believe they are prepared, ultimately collapse. You see, the 3 M's are not additive. They are not M1 plus M2 plus M3. They are multiplicative. Your success, your trading destiny, is the product of M1 multiplied by M2 multiplied by M3. If your method is perfect, if your money management is flawless, but your mind succumbs to panic or greed, the equation becomes 0. If any of the 3 M's falls to 0, your entire endeavor collapses. Consider the brilliant analyst. He is M2 personified. He can draw trend lines, calculate moving averages, and predict the next pivot point with stunning accuracy. But he suffers from a fatal arrogance, a failure of M3. He thinks because his signal is so strong, he can skip the safety harness and bet the farm. He risks 5% of his capital on a single trade, believing the odds are stacked in his favor. When the market delivers a single unexpected gut punch, a flash crash, a rogue news event, his entire account is wiped out. His brilliant M2 multiplied by a 0 in M3 equals financial ruin. Then look at the disciplined gambler. He has mastered M1 and M3. He is patient, he is calm, and he rigorously controls his risk, never risking more than 1%. But he has no edge. His M2 is based on flipping a coin or chasing the latest hot stock tip. Discipline applied to a non-existent strategy only means he takes small, consistent losses. His account doesn't explode. It simply bleeds out, slowly, week after week. Excellent M1 and M3 multiplied by a 0 in M2, the result is attrition. And finally, the emotional failure. This trader has a perfect M2 rulebook and excellent M3 position sizing rules written down, perhaps laminated on his desk. But under the stress of a losing streak, his M1 collapses. The internal structure fails. He throws his rulebook aside, revenge trades, doubles down, and violates every M2 and M3 principle he swore to uphold. The most perfect system is useless if the person operating it is a panicked child. The professional knows this truth. The failure is rarely spectacular. It is usually a slow, insidious rot that begins when one of your 3 pillars begins to crumble. Success is not about being right. It is about surviving long enough to let your verifiable mathematical edge play out. You must constantly audit the weakest link in your 3-part chain. Every day ask yourself, is my method still valid? Did I obey my money management rules? And most importantly, am I mentally fit to trade today? This daily self-assessment, this relentless audit of all 3 M's, is the only way to ensure that your trading destiny remains a product of growth, not a zero-sum game. Edge play out. You must constantly audit the weakest link in your 3-part chain. Every day ask yourself, is my method still valid? Did I obey my money management rules? And most importantly, am I mentally fit to trade today? This daily self-assessment, this relentless audit of all 3 M's, is the only way to ensure that your trading destiny remains a product of growth, not a zero-sum game. Now let us talk about the cockpit, the sacred space where M1, the mind, is forged. I am speaking of your trading room. This is not a casual corner of the house. It must be a fortress of monastic discipline. Do you think a surgeon operates while watching television? Do you think a fighter pilot takes calls during takeoff? Trading is a serious profession, demanding professional surroundings. Your physical room must reflect the control you demand of your mental state. If your desk is a mess, your mind is a mess. If you allow constant interruptions, you are announcing to the market that you are not serious about survival. You must accept that this profession demands a full, uncompromising commitment. Your roadmap for success is clear, and it follows a strict hierarchy. You must master M3, money management first. It is the survival mechanism. If you do not survive, nothing else matters. Next, you must relentlessly enforce M1, discipline and mind. You must build that fortress of control. Only then and only then do you refine M2, your method. Because a brilliant system in the hands of a fool with no discipline is simply a fast way to the poorhouse. Your trading destiny is not some cosmic lottery prize. It is determined by the daily discipline you apply to these 3 M's. It is determined by your willingness to look into the mirror and confront the fear and greed that reside there. Your future as a trader rests on a single choice. A choice you make every morning when the bell rings. Are you going to be the predator or the prey? Trading is not a hobby. It is a commitment. Now close the internet, open your diary, and begin the work. You can watch hundreds of hours of content and read dozens of books about the market. You are filling yourself with knowledge, which is excellent. But knowledge alone won't make everyone rich, because not everyone possesses the right foundation. The market is the same for everyone. The only difference lies in the mindset. You can have a perfect trading system, but if you lack discipline and an understanding of your own psychology, that system is worth nothing. I often see a recurring theme in your comments. It is easy to talk about strategy and theory, but when it comes to the actual trade, many struggle with emotions. For those who want to focus on discipline, patience, and self-discovery within trading, I have created a new channel called The Stoic Trader. I believe it will help many of you bridge these gaps. So if you think this kind of content would be useful to you, go ahead and check it out. The link is, as always, in the description below.